Hello, everyone. Thanks for joining. I'm pleased to welcome you to the first webinar of our multi-asset income strategy, which has been running since January 2015 and quietly delivering what it says on the tin. The call will be led by Jerome Stern, Managing Partner, and the Portfolio Manager, Jean-Yves Chiraud. They'll be joined by Charles Gélinet, who's been with the firm since 2020 and has many years' experience across the credit space in emerging and developed markets and in alternative funds. The team will cover our performance, the composition of the portfolio, and two examples of investments we've added recently. We already have some good questions, but please do send more if you wish. Before we start, I need to tell you that our fund is only suitable for well-informed investors. I will now hand over to Jerome.
Thank you, Sandy. Good afternoon to everyone who has joined us. Thank you for taking the time. Welcome also from me to our multi-asset income strategy webinar. Despite the volatile market environment, we are pleased with the development of our investment strategies and with the resilience of the underlying investments. Our business is growing well, with AUM now over $1.1 billion, supported by strong long-term performance as well as inflows. About 25% of the assets we manage are owned by my family and the partners, and the balance by other families, charities, trustees, wealth managers, and institutions. The multi-asset income strategy, managed by Jean-Yves Chiraud, is now over 7 years old and has delivered results in line with its long-term objectives of generating an attractive level of income with low volatility whilst generating long-term capital appreciation. The strategy invests in a diversified portfolio of concentrated equities, credit, and non-correlated assets, strategically allocated with a view to generating attractive income levels with low volatility. The strategy targets 6 to 8% per annum net of fees, of which more than 4% generated through income. As with our other investment strategies, quality is the defining condition for an investment to be selected, followed by value. ESG is fully integrated into our investment philosophy, and we strongly believe in the correlation between ESG, sustainability, and long-term investment returns. The strategy led by Jean-Yves has been managed by the same team since January 2015 and is available through separate managed accounts or through a Luxembourg RAIF fund, which will, by the way, celebrate its 3rd anniversary in November. Investors can invest alongside my family in a strategy that has successfully generated strong returns for close to 70 years. Despite the current market turbulence, I'm pleased to report the continued resilience of our multi-asset income strategy and its performance. As at 31 May 2022, the strategy was down 10.9% in dollars, slightly below the composite comparator index, but significantly above the MSCI World Index. Up to 31 December 2021, the multi-asset income strategy had generated 7.8% per annum in dollars since inception, 1% per year above the composite index. As at 31 May 2022, so including the current period of heightened volatility, the strategy has generated 5.6% per annum in US dollars since inception, also outperforming its comparator as well as the MSCI World. As long-term investors, we see the current volatility as an opportunity, as valuations of our companies have compressed significantly. And yet, most of them continue to report robust trading conditions. Despite the current market volatility, our convictions only grows that quality is the key driver for long-term sustainable performance with solid downside protection. Long-term investors, such as ourselves, contemplate these periods as buying opportunities, and we expect buyers will continue to step in across asset classes as prices decline. We remain optimistic about the global recovery over the next 2 to 3 years and confident in the ability of a focused portfolio to continue to deliver significant value over time. I will now hand over to Jean-Yves.
Good afternoon, everyone. Thank you, Jerome, and thank you, everybody, for participating to this first webinar on this beautiful summer day. As both Sandy and Jerome mentioned, the purpose of this seminar today is really to explain what the strategy is about and what it has to offer. First and foremost, looking at the core objective, the first objective is about total return of 6 to 8%. We believe that this strategy delivers the best of both worlds, an attractive income and some capital growth. The purpose of this slide, as you will see, is to explain how the allocation of the assets work. And therefore, you can see at the bottom and right, the 8%, which is part of the 6 to 8% range. And in the middle gray rectangle, the cash element, which is of 4 to 5%, in this case, 4.5%. The way the weights work here in this typical asset allocation provide the explanation with the cash yield of 4.5%. And in this case, the allocation is 35% to equities, 45% to credit, and 20% to non-correlated assets. The genesis of the strategy was really when I met some investors in the past who had a number of income requirements, and those investors were asking me how much capital they needed to allocate to us in order to deliver this income. And this is how we came to realize and construct the strategy, essentially based around the bottom-up selection of high quality securities. What is as well key to understand is that this strategy can be bespoke to suit other objectives. What are the core strategy objectives of the strategy? As I mentioned, the total return needs to be between 6 to 8%. Each asset class has to deliver a very specific objective. And the primary objective, as already explained, is an attractive income. It needs to be delivered whether distributed or actually staying in the strategy and being reinvested. The income as well plays a fundamental role in terms of volatility buffer. The potential of capital appreciation will come from equities, and we are looking at around 2 to 3% capital appreciation. This is achieved over the medium to long term, and for us, this means between 5 to 10 years. Last but not least, this strategy has delivered a lower volatility than market, and we are looking here at around half the market volatility. And this really is achieved thanks to a mix of assets and diversified securities in the portfolio. What is the role of each asset class? And that is really about the strategy approach. The equity asset class, with a range of allocation between 25 to 45%, is invested into high quality, large, and what we call mega cap equities. For us, for Geston, what that means is that we invest in winners. Those are companies which have dominant market share and are dominant players in their industries. This is how the capital growth is generated, and this asset class specifically is expected to deliver around 8 to 10% per annum compounded return over the cycle, as I mentioned before, 5 to 10 years. The credit portion, which accounts for between 35 and 55%, will be the main generator of the income. It is invested in quality, global investment grade and high yield corporate bonds. But we are very focused in having a short duration for the portfolio, the fixed income portfolio overall, which is below 5 years, but currently is around the 4-year mark. The non-correlated assets have a key or are a key component of this strategy. They provide both income, but as well capital growth. But one of their key roles is to reduce the volatility of the portfolio. It has a mix of liquidity, and around 50% of those are fully liquid with daily liquidity provided. The portfolio composition of the strategy, as you will see, shows that it is fully diversified. We are looking at around 65 to 75 securities overall, but each security presents a high level of conviction. The diversification is both around sector and industries, but as well geographies, and as well around themes. And the key themes for us, and including Jester, is about digital transformation, the consumer, both for luxury goods and staples, and the energy sector. We are very focused in delivering this diversification, and over time, we have seen that these provide lower volatility. Now, let's switch to the global equities. Within Jester, one of the key pillars of the investment philosophy, as we mentioned before, is investing into quality companies, because we believe that these pay rewards over the long term. The investment philosophy and investment discipline is unconstrained in terms of selection, but as we mentioned before, it is all about high conviction. And this is based on an intensive in-house research. However, we do not hedge the currency risk brought to us by the market, and as well the bottom-up selection of securities. And as we mentioned before by Jerome, a vast amount of the Stern family is invested in this asset class. But key is that we are investing for the long term. Now, I will pass over to my colleague, Charles, who will talk about the credit and the non-correlated assets.
Thank you, Jean-Yves. So credit really is a key component in delivering on the strategy's income targets. Returns are generated by a concentrated portfolio of high-quality corporate issuers, where we target 7 to 8% yield to maturity over the cycle. However, you can see by some of the metrics below that the current market conditions mean that today's portfolio is even more attractive, with an 11.5% yield to maturity and an 8% current yield. A noteworthy characteristic of the portfolio is that the majority of corporate bonds are based in emerging markets, where we believe the risk-reward opportunity is the greatest, as the actual risks are lower than the perceived risks. This is due to a number of factors, including geographic diversification, higher percentage of export revenues, lower leverage than developed market peers, and I think importantly, we need to note that all the securities we invest in are hard currency securities, which mitigates some of the FX risks that people may initially think about. Now, given some of the corporates that we're investing in may be less well known than some of the equities, I think it's a good chance to take us through one of the examples of a recent investment we've made. So if we can just flip to the next page, there's an investment we made recently in a company called Alsea. So they are the leading restaurant operator in 11 countries across Mexico, South America, and Europe, with over 4,000 units, generating over $3 billion of revenue. They operate 17 international local brands, including Domino's Pizzas, Starbucks, and Burger King. The key driver of this business to us is these are still underpenetrated markets, which provide good growth opportunity, whilst also at a time when there's increasing purchasing power in many of these countries. We like this business for the key reason that they benefit from exclusive long-term franchise agreements, which mean that they have exclusive rights to operate in these select markets. And then specifically from a credit point of view, why we like the business is it has high interest cover over 2 times and a good runway to delever, with leverage currently at 3.5 times and set to be below 3 times before the end of the year as economies open up post-pandemic. And as I say, this was a great opportunity, and we bought these bonds at the beginning of the year when we saw an attractive opportunity to buy them at a 7.5% current yield and a 7% yield to maturity for a bond that matures in 2026. And then maybe if I can just move on to the non-correlated component of the strategy, which is a key component to reduce the overall volatility of the fund, whilst also generating an attractive income and some capital growth. We primarily target third-party funds where the underlying assets are less correlated to traditional financial assets. You can see some of the examples there on the screen where we look at Biopharma, which is a pharma royalties business, Hypnosis, a music royalty fund, and then lastly, Greencoat UK Wind, which is a renewable energy infrastructure fund. So as you can see, I mean, from some of these, that the examples that we've given represent a diverse investment universe. And an additional benefit is that we gain access to what would otherwise be in a liquid investment set of opportunities, which we like. And as you can see there, around 40% of the portfolio provides daily liquidity, which is obviously very advantageous for us. And again, I think given that some of these names, again, might not be so well known to some of you, we just thought it'd be good to take you through one of these examples which we've invested in this year in Greencoat UK Wind. So if this fund is effectively invested in onshore and offshore wind farms across the UK. It has a portfolio value of around £3.5 billion pound sterling. And for us, the key driver for this business is the government decarbonisation agenda and the electrification of the energy system. And also, we think there's a key benefit in the fact that they have long-term contracts with inflation-linked revenues, which is obviously particularly relevant and important in today's high inflation environment. And then, as you can see just on the graph below, you can see that the net asset value of the portfolio has just grown steadily over time since its IPO in 2013, which we think is great. And it's delivered exactly what it says on the tin, with a 5.5% dividend yield and a total return of 8.9% since IPO in March 2013. So as I say, very, very attractive return profile there. And as I say, hopefully this gives you some insight into the types of investments we're making in both the credit and the non-correlated asset components of the strategy. And at this point, I'll pass you back to Jean-Yves to talk about how we allocate between these different components of the strategy. Thank you.
Thank you, Charles. How does the asset allocation works? As we mentioned before, the primary focus of the strategy is really to generate an attractive income. However, from time to time, there will be the possibility to essentially use the market movement in order to enhance the return through active and dynamic rebalancing. How we do that? Well, one of the principles we've developed over the years is the one of relative attractiveness. And for this, we are looking at the expected return of each asset class over the long term. And we are assessing whether at any given point in time, we believe that we can achieve the sort of return, first of all, the income, obviously, which is a priority, but as well, whether we can use the market opportunities given to us by the movement in order to better the expected return. How we done that? Some examples, for example, in March 2020, because of the pandemic, which was spreading across the world, obviously equities corrected, or all asset class corrected, but more particularly equities. And therefore, what we did, because of the confidence we have in each component on the equity side, we decided to increase the equity allocation. And this is something that you will see here on this chart. In the second half of 2021, has equity share price had increased quite dramatically thanks to lower interest rates. We decided that we'd reach a level whereby equities were actually less attractive on a relative basis to, for example, the fixed income portfolio, and we decided to reduce the allocation. Since the beginning of the year, we've been carefully watching equity valuation as well as the fixed income valuation. And after making a few changes to the fixed income portfolio, increasing the relative quality of credit of the portfolio or within the portfolio, we decided that equities had reached a level which started to be fairly attractive and started to increase again the asset allocation to equities. And this is a process that we are likely to potentially carry on further as equities correct further. Now, what about the outlook for current markets? Obviously, markets are currently giving us mixed signals or mixed messages, both from an economic but as well from a corporate standpoint. What we know for sure is that central banks, and especially the US Federal Reserve, have a very fundamental objective, which is to tame inflation. But as we know as well, this is going to be primarily data-driven. inflation figures that are coming out, and we've seen, for example, last week in the US, are coming out higher and as well with a broadening momentum. But we feel that this may be starting to peak. However, because energy prices are stubbornly staying high, there is obviously some anxiety in the market and some hopes that will subside, or those will subside at some point, and therefore provide lower inflation figures at some point. Although we believe that they may stay around with us for a short while. Global economic growth is slowing down, and it's slowing down from a period of high economic growth because of the recovery from an economy that had collapsed because of the lockdown globally. One important point this year as well has been China, which was in lockdown and is currently reopening, and fingers crossed will remain so. And this should prove or should provide a substantial boost to the economy, the global economy overall. But we do expect global economies to slow down. Corporate earnings. One of the key issues for corporate earnings is a challenging comparison with the previous year, 2021. And there is no doubt, in as much as we expect a slowdown in earnings, for a couple of quarters, market will have difficulties just to get the full view of what is the expected growth going forward. Another factor which is creating shadows in this perspective is the fact that for companies which are reporting in US dollar, which is a fairly important part of what, the components of our strategy, the currency movement is presenting a substantial headwinds in terms of reporting because of the strength of the currency so far this year. The market sentiment is at multi-decade low. And as we've seen as well, it is the case as well for the consumer. This is likely to stay with us until we've got more visibility as to what is happening with inflation and as well with consumption. Valuations, as I just mentioned, we've seen, as the market corrected, some attractive valuation presenting itself. That has been very much the case for the corporate credit portfolio. And as I mentioned, we did a few changes there to take advantage of that. And it is very clear after the past few days and the past week, where equities have corrected quite violently, that we are now approaching a very attractive level of valuations for equities. And this, unfortunately, if market correct further, could prove to be even better. This is not our expectation right now, like it is not the expectation that, or our expectation that we are heading towards a recession. But again, we are lacking the volatility. We are not market timers, and the way we look at investment is certainly being very focused in investing for the long term and using those sort of opportunities. As we mentioned before, we do our own research, and we believe and we have high conviction in our stories, in our investment, and we only invest in quality companies and quality stories. Thank you very much, and I will give back now to Sandy for him to open to questions.
Thank you very much, Jean-Yves and Charles, for this presentation. Well, thank you as well to everyone to have sent us the questions. Please continue to send them. We will address them as during the Q&A session if you have any topics which you would like us to address. I will go now through the questions which we have received to date. And if we look at it from a top-down point of view, from a macro point of view, what is your view? I mean, it is quite clear you referenced the fact that inflation was amongst us at levels, obviously, which are currently at the peak. Now, what is your view that inflation is going to stay with us higher for longer? And how does this affect, the ability of the portfolio to continue to deliver on its income requirement?
Well, I think the markets have been surprised in general by how high the inflation number have come through, but as well for how long. And clearly, not only the markets, but as well central bankers in general. What is clear for the moment is that there's been a succession of events that have triggered this. First of all, obviously, there was the pandemic issue and the lockdown in China, and that created supply chain issues. But those were further compounded by the conflict between Russia and Ukraine, and that put pressure on prices both for energy and food. So altogether, those events came one after the other, and obviously triggered the price rises we've seen. Unless there is a quick resolution for the conflict in Ukraine, I think it is likely that both energy prices and food prices will remain under pressure. Now, what is likely as well is that as consumption the consumer comes under pressure, there will be less demand, and therefore there is the possibility that inflation number will start peaking. One other issue has been job supply as well. As we've seen, and this has been a global issue, any economy you're looking at, where there's been shortages, and that has put pressure on salaries that employers have to pay out. And obviously, what has been good news for the employees in terms of rising income has become an issue as well for the central bankers. Now, the good news for the strategy is that in what used to be a low yield environment, we've been able now for 7 years to generate the level of income that we mentioned before. And the good news is that as interest rate increases, clearly the rate as well, the expected rate, that should be provided by the corporate should increase as well. And what we've seen, and currently it is the case, what we've seen is some of the higher quality bonds have come under pressure because of the higher yield, the higher sovereign yield, like the 10 years Treasury yield in the US, essentially when you have longer duration. And we've used that opportunity to actually improve the quality of the portfolio, the fixed income portfolio overall. So it is not at all negative in our case. There is a question mark as to the potential capital gain, but much less so as far as the generation of income is concerned.
Understand. So coming actually to the portfolio itself, the content of the portfolio looks to be very, very international from a UK point of view. What is the percentage allocation to the UK? This is obviously more a question which has come from a UK-based investor.
Effectively, the portion of exposure to the UK is very limited, both from a I would say listed security, but as well from a sales and profit standpoint. And the main reason for that is, as we explained before, the process overall is bottom-up driven, and as such, we are looking for the best companies around the world, and the mix of companies which are present to us, and the process is actually pretty agnostic in terms of where those companies are listed. All those companies tend to be global companies, and therefore will have a mix of currencies and as well as a mix of geographies. The actual country exposure is not a criteria for us, especially for equities, is not a criteria of selection. It is more important for the fixed income, especially for emerging market.
That makes sense. Going to the equity position, the split by industries is very revealing. I mean, is this how dynamic is this, or is this this industry allocation set for now?
Well, the industry allocation is I would say pretty stable over time. Although, as again, the selection process is bottom up. And since we invest for the long term, we are looking at long-term trends, both for each individual companies, but as well for the themes that support the investment theory. And therefore, it is difficult to see a lot of volatility in terms of switching from one industry to the other. We are very, very confident that the themes we follow and the themes we've chosen are themes which are going to provide us with, with very good returns over the long term. And this has been the case for the Stern family, and we haven't changed our process and investment philosophy because this had worked very well over a very long period of time.
Very, very interesting. We've talked about inflation. Obviously, then it's company investing in companies or in businesses with pricing power is even more important. Can you give a few examples of how this is relevant and how how pricing power is actually a criteria within the strategy?
Yes, absolutely. I mean, all the companies that we select, especially on the equity side, as we mentioned, have a very substantial market share. They are number 1 or 2 in their respective industries, and as such benefit from pricing power. Even those who can be more susceptible to pricing movement or price movement, like for example Nestle, because of the impact of commodity prices, for example, when you buy cocoa or coffee, etc., have such pricing power and such dominance in their market that they can manage their profitability as well, including the fact that because they have superior management, they have room to actually manage their margins over time. And we've seen that for a very long period of time. We've been invested in such companies for 30, 40 years in some cases, and they've been able to deliver this pricing power on a compounding basis.
Very good. Also focusing on the equities, how long do you hold the equity positions for, and what type of turnover is there in the portfolio?
The turnover is very low. The turnover is, I would say the average holding period is anywhere between 5 to 10 years and sometimes longer. As I mentioned before, we are looking at market leaders. We are looking at fundamental themes, and essentially, the company we believe in, we hold because we believe that they will generate superior return for a very, very long period of time. So as a result, the turnover is very, very limited. We might be buying 1 or 2 companies, new companies per annum, and selling 1 or 2 per annum.
And if having the same question on credit, just a quick segue on the new asset class.
So the credit is slightly different in the sense that one of the opportunities with the credit is that we can use with the same issuer several different bonds, different duration, different yields. And what we will do is, in as much as we buy and hold the bonds theoretically to maturity, and as I mentioned, the duration of the portfolio is around 4 years at the moment, we can arbitrage sometime between different bonds within the same issuer, or different bonds or different issuers within the same universe, just because we have opportunities and fluctuation in prices. But the themes remain the same, and essentially it is really, or the purpose is really to enhance the return.
More question to Charles then on the bonds portfolio, about being a significant portion of the bond portfolio is allocated to emerging markets. What are the key countries within that, and what are also the key countries you tend to avoid?
Sure. So we tend to focus on some of the larger EM countries, which constitute a significant percentage of global output. So we've got, significant exposure to Mexico, given their links to the US, to Brazil, given the export commodity export opportunities that we see there, and also to Turkey, where we see, good manufacturing base. So as I say, good exposure to those countries. However, we have been, let's say, more conservative and actually avoided places like China, given we think that corporate governance and the visibility is well very low there. So we just don't get comfortable with some of the opportunities that we see. Likewise, in Russia, we actually haven't been invested there. Prior to the crisis, we weren't invested because we thought, there was a risk potentially of sanctions. Obviously, we didn't see exactly what was going to what was coming up, but we just thought that given the geopolitical risks in the country, we thought it's actually sensible to stay away from the likes of Russia.
And continue staying on credit. At one point in time, you have the ability to go into high yield. Can you please describe what you decide and how you decide the mix between high yield and or developed market high yield and emerging market bonds?
So in terms of sure. I mean, I think for the time being, a large percentage is in the emerging market side on the high yield space. I think we feel that the businesses we see there are actually, like, let's say, far higher quality in terms of the underlying businesses. Yet, and we're getting a far, or let's say, a more attractive return profile for an equivalent business that would be in a developed market. And I think I tried to allude to earlier that I think you're getting rewarded for certain perceived risks, which we think actually aren't really there. So we just, as I say, again, we are focused on a concentrated portfolio of companies where we do significant underlying work on these businesses so that we can hold them. And we believe that they'll run through any potential idiosyncratic risks that we see in these countries.
Okay. Can you please also give us the rationale why you tend not to invest in sovereigns?
Sure. I think with corporates, we think we can go and we can analyze these companies and we can look at them from a fundamental basis. I think on the sovereign side, which we don't look at. Firstly, you have to analyze the ability of the sovereign to pay back on debt, but you also have to think about the willingness of the sovereign. And so there are geopolitical risks that come into play, which I think are not our expertise and something that I think we play to our strengths, and that is very much in corporate analysis.
That makes a lot of sense. Switching over to the non-correlated assets or the uncorrelated funds, I mean, how does the research process work there? And what are the key steps?
Sure. I mean, we really do look to apply the same quality approach to what we do on the equities and credits. So this is very much based on a rigorous in-house research process where we screen across all the different funds that we see, and then we apply some high-level, let's say, qualitative and quantitative criteria. And then we look at the return profiles, the liquidity, and also the correlation that these funds have to the other assets where we own. And then at this point, we drill down and do the fundamental analysis on these funds to see what the key drivers are for them, and then also to understand like the key risks to what could happen to these funds, and then also the opportunities to see whether they will continue to deliver on their objectives. And as I say, then once we've done that, it's very much a case of putting together a detailed investment paper, which we take through investment committee, which will either then get approved or not. And then at that point, we can look to invest either at that point or at a point where we think these are great opportunities now or potentially in the future when valuations look more attractive.
Okay. I mean, in terms of investment vehicle, I mean, the strategy can invest in private funds as well as in listed closed-end funds such as investment trusts. Is there a criteria to choose between both, or is it totally equivalent?
Well, there are three criteria in general for investing in funds. First of all, obviously the income generation, whether this is distributed or it's accumulated within the NAV of the fund. The second is the non-correlation or the limited correlation. And the third criteria is really about liquidity. And what we've been trying over time is to focus on those funds that provide an attractive level of liquidity relative to the return. We've had many opportunities over the years to invest in higher return vehicle, but with the difficulty that those tend to be closed for 7 years. This is not something that we'll be contemplating. The longest sort of period is we are looking at around 6 months, sometime plus. Otherwise, as Charles mentioned, around 40% of the investments are daily, provide daily liquidity for actually very attractive returns.
How much, just focusing on those non-correlated assets again, how much of those are focused on pure ESG-driven strategies, like renewables, like batteries and things like that? Is this a significant percentage?
We have, I would say, around, so within the strategy, the pocket, which is, let's say, 20%, there is around maybe 30%, which is invested in renewable energies.
So taking advantage of this. And is there a risk associated with that? Especially, it also comes from a domestic investors mind, but concerned about the potential windfall tax, which is being touted here in the UK.
I'm sure. I mean, it's something we have been looking at carefully. I mean, obviously, Rishi Sunak came out with his recent announcements, which are targeting, for now, the oil and gas companies. However, you've actually seen the share price of some of the renewables come under pressure, given people are concerned that potentially they turn their attention to these renewable companies too. From our point of view, we don't believe it's going to happen, given I think it would send the wrong message to renewable companies. And I think from that perspective, then you probably wouldn't get the same kind of level of investment in the space, and then the government wouldn't be able to reach its net zero target anytime soon. However, if it does happen, we have considered that and we're looking at it. And we've modeled it out to see what would happen to the cash flows and to potential NAV implications. And for us, I mean, our expectations are that if it were to happen, it could have an impact of around 3% on the NAV, which is something, but we think it's manageable. And I think at that point, it's actually probably, you would argue that it'd be a good time to invest given the share price depreciation. And I think you also have to argue that you'd have to kind of question how long these types of tax levies would be put in place, and potentially it would likely be short term. And you see, even with the oil and gas levies that they've designed so far, that effectively there will be tax relief further down the line, which would then benefit the company later on.
Absolutely, that makes sense. Lastly, question about ESG. How is ESG then integrated into this, from a firm point of view first, and secondly, how is it applied within the realms of the multi-asset income strategy?
Sure, I can take that. So from an ESG point of view, I mean, we really follow a formal framework on ESG, which identifies specific issues. We follow more, let's say, an integration approach to the topic based on the SASB materiality dimensions. And we also, on top of that, overlay a proprietary corporate governance review to each of the investments we make. And I think this really helps, let's say, identify both the risks and the opportunities within a business, and ultimately, it helps us form a more complete analysis of each investment we make, and let's say, helps us form a more complete investment thesis for everything we do. And as I say, it's something which is done prior to every investment we make. And as I say, it's something that we have a designated ESG committee, which reviews all of the investments, both from the equity, from the credit, and from the non-correlated side, to see if these kind of investments stand up, let's say both from a financial point of view, but then also from an ESG angle too. And as I say, that's done. And I mean, and as I say, every single investment is taken through that process. Yeah.
Fantastic. That's all. These are all the questions which have been sent to which has been sent during the before and during the webinar. So first of all, I wanted to thank the audience and for the engagement and for all the questions which have been sent. We hope that that those have been all answered. Jean-Yves, Charles, you want to say a few closing words?
Yes, potentially. As we've mentioned since the beginning of the presentation, the strategy has essentially delivered what it said on the tin, and we believe that we are exceptionally positioned right now in those difficult markets to actually reap the reward of the current positioning of the portfolio, both from an income standpoint, but as well with potential capital growth. We are looking now at the very attractive entry points, and we believe that as long-term investors, there will be great opportunities to make money over the next number of years. This strategy is presenting an incredible opportunity with a lower volatility than the market, but as well substantial amount of income.
Very good. Thank you very much. I mean, and it will. So also from me, thank you very much for attending this webinar, and we look forward then to welcoming you on another webinar soon. Thank you very much. Thank you.
Thanks a lot. Bye-bye.